Welcome back, everyone, to episode 22 of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside Mr. Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, the recent Federal Reserve meeting, a relatable 80s market or 80s article, a breakdown on the abnormal spring market, home insurance, secondary mortgage market, and plenty more. But first, I have to take a second and acknowledge our new YouTube intro. It's pretty cool, isn't it, Stephen?
Yes, we've already had a couple comments on it.
Exactly. All right, but first, Stephen, what is going on in the large Thomas household?
Yeah, so we have a lot going on, but for me personally, if you're watching this on YouTube, you could see. If you're not watching it, you're just listening to this in leisure of in the background or in your car. Let me explain to you what everybody else is looking at. They're looking at this, looks like a wound on my lip. And what that is my public service announcement for everybody to listen to their significant other. When your significant other tells you to wear sunscreen and shakes her head when you didn't put it on, or it tells you, hey, where's your hat? And or asks you where your hat is and you're not wearing a hat, you know what? You really need to listen to your significant other, because that's exactly what my wife was telling me. And as it turns out, look, most likely I got this dug out of my lip, and I got something dug out of my my neck, and then a mole removed of my chest. Saw my dermatologist, and she said that we'll get the biopsy back in about 2 weeks, and we'll mail you a letter if it's nothing, but we'll call you if it's skin cancer. And she said expect a phone call. So in other words, getting me ready for, we're going to have to even do more work on this. So guess who's wearing lots of sunscreen and wearing hats? It's this guy right here. So public service announcement: wear your sunscreen, wear your hats, and try to insulate yourselves from the harmful rays of the sun. But other than that, we're just winding down. We only have a few more weeks till the end of school. So we're a very, very busy household. We have somebody graduating from high school. We have somebody that is going to be finishing up the 8th grade. And then we have our little Zeke that's finishing off Montessori and will go into 1st grade next year. So very, very busy time of the year, that's for sure. How about you? What's going on in your neck of the woods, Brennan? I'm pretty sure it has something to do with football or soccer as we know it.
Yeah, I mean, we're down to 3 games or actually 2 games left for us and 3 for some other teams. Arsenal's
When
my
you say
team.
for us, wait, who's us?
Us as an Arsenal, I speak for us. It's like a big family. I consider myself one of them. That's like I'm yeah, I'm part of the family. But we have just a couple games to go. We are like technically 1 point in the lead, but another team has a game in hand and they can win the league. It's just, I at first was sad thinking about this, and I was like reflecting on this a lot over the past week. And I was like, you know what? A couple years ago, we were in a pretty bad point in the league, and I am just happy to be second. Like, that is, come on. I got to be grateful. But if we get first, you can expect me celebrating on this and everywhere, pretty much. I will be screaming for as long as possible. So it's been 20 years. It's about time. It's got to happen at some point. But fingers crossed. I'm hoping for the best. I'm praying for it. It's maybe soon. We'll just have to see. Other than that, we've been pretty busy, which I will give you the reason why soon. It's a pretty big announcement, but everything's been good so far. But like usual, Stephen, what's been happening in the real estate world with supply, demand, and our very own expected market time over the past couple weeks?
So we were having inventory really rise a lot faster over the course of the last 6 weeks. It slowed down a smidge because interest rates came down from 7.5 down to under 7.25, and it's reverse course. So we had interest rates that were going up, and now it's coming down. And what that's allowing is for the inventory not to grow as fast. Yet we're seeing a further increase in demand right now. And this is kind of what we've alluded to in the past, that as interest rates fall later on this year, that what we'll see are interest rates coming down. We'll actually see a rise in demand. Inventory will have a very hard time growing. So that's what we're seeing in all markets. We took a look at all the markets that we cover, and yep, that's kind of what's going on. It's the same thing we're seeing. So the speed of the market is no longer slowing like it was as interest rates were rising. So since interest rates were coming down, we're getting the speed of the market kind of remaining the same rather than slowing further because of the rising rate environment. And which shows you, and we haven't even gone that far down in rates, that if rates were to come down even further, you can imagine that the market would actually heat up. So that's where we're at right now.
So the big announcement that has kept us pretty much on our toes and very busy recently is we just released the Clark County, so Las Vegas, and Maricopa County, Phoenix housing reports. So Stephen, what are you noticing in these separate counties?
We actually launched this week, finished those reports on Tuesday, and then I flew out to Vegas on Tuesday, and then Thursday I flew out to Phoenix. So Vegas and Phoenix in the same week. And what we're noticing is that Vegas is very, very, very similar to last year. It was a little bit hotter, but now it's very, very similar as far as where the speed of the market's concerned. Inventories for the first time in since a year, there's actually more homes on the market than last year, but like 20 more homes than last year. So not something that's significantly larger. And so the market feels very similar to last year. But now if you look at Maricopa has a lot more homes on the market, several thousand more than they did last year at this time. It's not even close to where they were prior to COVID. However, it's more homes. And demand is very, very similar last year. So if you have more homes and very similar demand, it's actually slower right now. And it's noticeably slower in the markets, except for the entry levels. Price ranges pretty much across the United States. That's the way it works. The entry levels are the busiest, but then as you go higher up in price, you have to be a little bit more careful in pricing in Maricopa specifically that I was talking about. So that's what's going on. It's pretty fun and exciting. We've been following that data for a long time, but now we have a report. It's all locked and loaded, and it's actually, you can go to reports on housing.com and subscribe to either one of those reports.
It's pretty neat stuff. I gotta say, congratulations to you and to us. It's pretty exciting.
Yes.
Yeah. But Stephen, what happened with some of the most recent economic releases?
Yeah, so this week was kind of like a boring week for economics, but we do this podcast every other week. Last week was a very exciting week. It was the first full week of it was the first week of May, and then what we had was not even, it wasn't even a full week, but what we have in that week is we have job openings, which were actually a lot lower than expectations. Came in under 8.5 million when we were at 9 million just a couple months ago. So that's coming down. Prior to COVID, we were in the sevens. So that's what we need to do, is we need to get back into the sevens, but it's now not as far from 8.5 down to underneath of 8 million. So that's job openings. The other thing, then what happened is that the Fed met. And so that was another big data point as well. And I know you're going to ask me, so what happened in the most recent Fed meeting? That's important because that's an actual economic release. They don't really forecast what they're doing with the interest rates. They do that every quarter. They tell you where interest rates are going to be. But through their language, you can decipher where they're going. And they were a lot more conciliatory, dovish than many, many people had thought because of the earlier readings of CPI and a number of economic readings that were really very they were too hot for our britches, United States economy readings, including retail sales, CPI. But then PCE came out the prior week, and it wasn't as strong. It wasn't. It was kind of right there where it should be, so it wasn't that bad of a report. So that's why they kind of were a little bit more dovish. And I think they knew a few different things because job openings came out. Then on Friday, we had the number of jobs that were created for the month of April, and it came in like half of expectations. So it was way less. So once again, there's more signs that there is a slowdown. There's also consumer sentiment now. The sentiment survey came out today, and it stated that consumers are worried about inflation. When they worry like this, that means they curtail their spending also. So if we're seeing this shift in the job market, which is important, And then this week we had this big spike in initial unemployment claims. It was the biggest spike in a super long time. So all of a sudden we have a whole bunch of unemployment claims. So if you look at everything, it's kind of now pointing to what we've talked about, that slowdown, not where we're going into recession, but where the economy slows down enough where you'll get a flight to 10-year treasuries and mortgage-backed securities. And when there's that slowdown and you have that flight to 10-year treasuries and mortgage-backed securities, we have interest rates that come down. And so this is kind of like alluding to that fact. And we just need a few more economic readings that are less than expectations or show that this trend is continuing, where the dovishness, the conciliatory language that the Fed just had, will paint a picture of the rates coming down. So even more. So now we understand why they were kind of speaking that way. It's kind of how we've been speaking, and which means that there's a lot of people that were saying that we're not going to get a rate cut. Some are in the camp of none at all. Some say it'll be November, but most everybody is moving it to September. Now we still have quite a few readings until they meet in June. And as a matter of fact, I think it's later in June, so we might get 2 CPI readings. I'd have to double check that, but we get a couple CPI readings, and we get another labor data and retail sales and things like that. That could paint the picture to it happening as early as June, which is actually where they would rather go, because it's far enough from the election where they won't be accused of interfering with the election, because they actually don't like to interfere with the election, contrary to what anybody says. Now, if they wait and don't do it in June, then next time is what? September. Now, if they did it in September, there'd be if there was a whole bunch of things that broke, they would have to move. And there's a lot of people that point fingers at the Fed saying that they are doing this for political reasons. That's not what this is about. So we're watching all these numbers, and hopefully that they continue to pave this pathway to a gradual slowdown where it's this, quote, soft landing. My biggest fear is that they don't make this rate cut in June, and then they cause more damage, and then you'll get a harder landing, which affects more of the economy. And so that's the camp that we're in. Hopefully they'll be in that same camp. And I'm starting to hear it in a lot of the different talking head channels, where they're seeing some of the same headwinds that we've talked about with personal savings rates and excess savings from pandemic stimulus packages gone, and retail credit card debt blossoming or ballooning, and a lot of delinquencies there, and in automobiles. So everybody's starting to look at what we've been talking about for several months now.
So with back and forth economic readings, I feel as if we've seen something of an abnormal spring real estate market. Now that May 1st was the official halfway point through spring, what have you noticed about this spring market?
Yeah, the spring market could have been a lot hotter. If we would have maintained those interest rates below 7%, everything would have been really good. And as we can already see, that going from 7.5 to like 7 point, I think for Freddie Mac, it was like 7.1 or something like that. Going from as high as it was all the way down to, getting down towards 7% already is making a difference in demand, as well as homes coming on the market. But we could do even more, could have done even more if it was below that 7% threshold. As a result, you could actually see this squeeze in the number of homes coming on the market, where we were getting a lot more, but then it was less. But overall for April, it was a bit of a surprise. There are more homes, so we'll get into that later. But that is something that we could have had an even better spring. And what I mean by a better spring, it's more homes coming on the market, as well as more demand, which means more pending sales. If we have more pending sales and more homes coming on the market, there are more people that are able to sell and to buy, and there's more movement, which is a healthier real estate market. The real estate market has really been frozen shut, and the further we get down in rates, the more that will allow it to thaw out a bit.
In a 1980s article discussing why didn't housing prices fall with mortgage money drying up and interest rates soaring, they said in April of 1980, for example, when sales of existing homes plunged to an annual rate of 2.42 million units, which is the lowest in 5 years, prices rose to the highest level ever recorded for resale homes. With mortgage payments nationally hitting an all-time high, today, Are we able to relate to some parts of real estate and economy today with what we saw in the 1980s?
Yeah, the economy is different because the recession back in the 19, not the recession, the inflation back in the 1980s was really egregious. It was embedded in the United States economy from the 60s through the 70s and 80s, and they were trying to get a hold of it. And so they were doing everything in their power, the Federal Reserve, to step it up and fix it. So part of that was jacking up rates, and rates went as high as over 18%. And people go, 18%? Can you imagine? They're only at 7%. People actually allude to the fact, look how high they were back then. Yeah, it was actually more unaffordable for most markets across the United States. There are some markets that even at today's rates and today's values, it is more unaffordable than when rates were hit 18% in 1981. So, but the similarities, if you strip out the inflation and you take a look at, because inflation's coming into it's coming down kind of where we would really like to see it. Is nowhere even close to where it was during the 60s, 70s, and especially the 80s. So, but what we can see is that big giant jump in rates. They went from like 9, 10% rates to 18% rates. We went from 3% rates and even down into the twos all the way up to 8% rates back in October of last year. So big giant shift. And when you have that big giant shift, what it does is it keeps everybody in their houses and they're not moving. And it doesn't allow a lot of these first-time homebuyers to be able to purchase. So have we been here before? Yeah, it really feels similar because you, specifically you, Brennan, have been sending me all these different articles that started with the Sacramento appraiser who is from the Sacramento Bee from 1981. But all these articles from back then that talked about how hard it was and difficult it was and how prices were going up and buyers, that first time home buyer patch back then, it was the baby boomers. Now it's the millennials. We're having trouble purchasing. And the only real fix to this is down the road when rates come down. And that's kind of what we are waiting for at this point in order for them to actually enter into the marketplace. Many are still entering. It's limiting the number that actually have the ability to enter because of how high rates are, even at 7%. That 7% is like coming down from 18 down to 16. It needs to come down further in order for it to open it up to all the millennials and Gen Z that are interested in purchasing. So those are the similarities that we see, that you could kind of find the parallels. But as far as the parallels in inflation and the exact economic circumstances back then, we're a completely different economy right now.
So I want to take a second and recognize that Stephen and all of us at Reports on Housing are not cheerleaders for the real estate or for the economy, but rather wish the best for everyone. On the flip side, we do report the facts as they come, whether good or bad. But Stephen, with so much negativity on real estate, mortgage rates, affordability, supply, and what have you, what are some positives we can turn to?
Yes, some of the positives that we can turn to right now for the month of April, in us looking at the number of homes that came on the market compared to April of last year. April of last year, for some reason, it really was locked in. There's a lot of homeowners that did not place their homes on the market this year. And we've already shown in January, there were more homes that came on the market than January of 2023. And then February was kind of similar, but we had rates that were rising. When we got to March, all of a sudden it was squeezing a little bit closer to each other. And I was going, gosh darn it. And I was kind of saying that had to do with rates that were going higher, but then that didn't explain what happened in April. Because April, even though we hit 7.5% interest rates for the whole month of April, we had a lot of homes come on the market, a lot more than last year. So it's still off from where we were prior to COVID, but it is a giant step in the right direction. It is what we refer to as a green shoot at the beginning of this year, and it's big enough difference that I want to write an article about it. Our upcoming article will be all about this because this is a real positive. For those buyers that have been sitting on the sideline waiting for something to come on, finally, there are more homes that are coming onto the market. And as rates drop further, we anticipate that more and more homeowners will play. And as we get closer and closer to 6%, people are going, how are we going to get all the way down to 6%? Shoot, we were at 8% back in October. We got to 6.5% by the time we were at the end of December. That's a big change of 1.5%. We're playing right around 7.2% right now of a rate. To go all the way down to 6% is not a giant stretch. All we have to do is for the economy just to downshift a bit, to slow its speed. If that happens, all the way down to 6. And that's when I'm going to say a lot of people will see another positive, and that's when they jump in. I would lock immediately when that happened, because typically what happens is the rates come down really fast. And then after that, it's kind of like they went too far down, and then they start to bubble up a little bit more until we have the next slowdown or another downshift down. So that's coming, and we're already seeing it with more homes coming to the market. And you can imagine at 6%, there's going to be even more homes. We've talked about it here before. What happens is they have these underlying interest rates where if you look across the United States, it's close to, I think it's 80%. In some markets, like in California, it's 89% of everybody has an interest rate below 5%. But across the United States, it's just about 80% of everybody has an interest rate if they have a loan at 5% or lower. Well, when you're at 7.5%, it's not that great. But if you're at 6, and someone else has an interest rate at 4.75, that's not a big enough difference, number one. Number two, when they locked these things, they locked these interest rates over 2 years ago. We're going to hit the 2-year mark of being at 7% right now. So you've got to go all the way back to like early 2022, where a lot of these people did it, or 2021. Now they might be locked in these low rates, but it's been so long that their incomes have risen, even though their payments have been fixed over time. So it's allowed them to accumulate more savings, allowing them to do even more. And that's why we're going to start to see more and more people place their homes on the market as rates come down towards that 6% level. And if we get underneath that 6%, man, it's going to be one crazy real estate market. Because the lower it goes, the good news is we've kind of established that 7.5, and it looks like there's a lot of things in the works for rates to come down as the economy slows a bit. And so we're at that point where we're kind of established that height at 7.5, and it's coming down a little bit. And as it comes down, we will see more buyers participate, and we'll see more homeowners participate. So that is a good news for anybody involved in real estate, as well as all those buyers that have been waiting, and sellers or homeowners that have been waiting to sell, and now they'll be able to because rates have come down enough to allow them to do it. So we do more transactions, and it adds more juice to the economy as the overall economy is slowing down a little bit.
So with the US having chronically low inventory and muted demand, a mixed emotion statistic came out recently stating from Redfin that for the first time in nearly 2 years, there's no major American metro where home prices are falling, which is crazy. What does this say about the US?
Says how resilient the housing market is, and they're absorbing these higher rates. At first, when we had those rates, there was a rate shock, and it was so bad that we actually saw a major deterioration in pricing. And then towards so now we've been used to these rates bouncing right around the 7% threshold for quite some time, to the point where people are just used to it, and they're tired of waiting. So like I said, we have more homeowners that are participating because they're tired of waiting. I used to ask people if they had less than a 3% interest rate, or 3% or less, if they'd sell it. And I used to get people laughing. I still get people laughing, but there are now hands in the audiences where I speak, where they're saying, I want to sell. And they all have their various reasons, which is good news. That just means that they finally want to participate. They're tired of waiting. And so it's going to add more fuel to the fire. And so we did go down quite a bit in value, not a ton, but we went down in value for the second half of 2022 as rates were migrating from 3.25 at the start of the year all the way up to 7%. It's too big of a burn. Now that burn is healed, and everybody is used to these 7% interest rates, and or in the 6s, they feel really good about in the 6s. And if they got in the 5s, people go, man, that is a great rate. I remember before, people were going, Steve, do you ever think that interest rates will get back into the 4s or back down into the 3s? people aren't asking that anymore. They're just excited when rates get down into the sixes, and if they get down into the fives, their expectations have totally changed. So has everybody else's expectations. So you have these interest rates that have been slogging right around 7% this year, and it's matched up with the stabilization of rates at 7. Yes, it is higher. However, it's also in the midst of a spring market. And that is enough where we're seeing the positive prints for pricing with metros because we've had that stabilization. Now, we don't want interest rates to remain above 7%. For homeowners, a lot of homeowners won't play, and then we'll have fewer buyers out there, and then we'll have a little bit of deterioration in pricing towards the end of the year as the market slows a little bit. So if you're rooting for more people to do transactions, what you need to root for are for rates to continue to ease a little bit. Under 7% will be a big difference. And then what you'll see is a gradual increase in all metros to continue as long as rates remain low. And that's what our anticipation is. So yeah, that's just a product of very, very few homes available. There are more homes coming on, which means that prices won't skyrocket as much. But you can imagine if rates go all the way down to 6%, that's going to invite a lot of millennials and Gen Zs to jump in, and we'll get a real heat up in the marketplace as well, which means not a lot of available homes, a lot of homes that go into pending sale status. So we will be right back to square one with not enough homes available. So there are more, while there are more right now, and we're accumulating a few more, they will disappear as rates fall.
So on the topic of everything heating up once interest rates do drop, with housing prices for all major metros, like we spoke, for most of the US as well, increasing, would you still say that now is a good time to buy?
Yeah, I think I just alluded to it because really what happens is as rates fall, it really does spike demand. It does spike the number of homes coming on the market, but unfortunately, for the way the market is, the demand that demographic batch of first-time home buyers, millennials, is the strongest demographic patch since the baby boom generation that had to deal with 1981. Same thing now. The millennials and Gen Zs have to deal with this. As rates come down, there will be a lot more demand and they'll be competing against each other. There will be more homes, but they will outpace the number of homes coming on the market. So as a result, what will happen? Prices go up because it's just going to be that scarcity is going to increase. And you know where this will have the biggest impact. It will be in the entry level. So yes, we'll see more homes coming on the market in the entry level, which we definitely desperately need because builders aren't building enough at the entry level, A, and B, these homeowners that have these low rates, those are the most reluctant to trade in their low rates for a high rate and sell their home and move until rates come down. So I just think there's going to be so much competition, and it just has to do with trend lines and looking at trends that we will see values go up at a pretty decent clip, especially in those lower ranges.
So a few episodes ago, we spoke on home insurance becoming a larger issue in the purchasing portion of real estate. To this day, it is just as difficult, if not worse than it was before. What do you see happening with home insurance in California?
Yeah, so we always said take a look at Florida because they went first. Now Florida is having a major problem because they had a absolute disaster of a hurricane, and that hurricane wiped so many houses that they redid a lot of them, and people moved, and now they're selling these houses. So there's a lot of selling that's going on. Guess what? It is adding to inventory, and if you actually see where the most of the growth is for inventory across the United States, a large portion come from two states, Texas and Florida. And Florida has that big insurance problem. And Texas has this big property tax issue. So the combination of the two is creating a lot more sellers because of the changes that are going on. And insurance is very, very expensive. Well, it doesn't seem like California is coming up with a fix. So what's ending up instead is we have insurance carriers that are limiting the number of insurance policies that if they're even insuring in California, they'll limit the number that they do on a monthly basis. And there have been insurance companies that have been vacating California, just like Florida. It's like as if California legislatures and the Department of Insurance can look right over across the United States at Florida and what's going on, and they can learn a valuable lesson. And it's like as if that valuable lesson is not being noticed. And you look at it, come up with some darn solutions for Pete's sake. Change the way that it works for these insurance companies. They have to make a profit. That's what they do. So if you're not going to allow them to make a profit, you can't force them to insure in the state of California, and it's going to be sayonara, Californians, gone. And that's exactly what's happened. So they need to restructure and do something a little bit different, because that's just the nature of the beast and what they're dealing with. So I'm hoping that we'll see something on the front. There has been quite a bit of talk, but yet no real solutions as of yet.
So a headline of an article said, was it meant to be what happened to the best place in California to buy an Airbnb, when they were speaking of Coachella Valley? Would you say that some Airbnb investors may be in over their heads a little bit?
Yeah, this Airbnb craze, this is why people thought there'd be an Airbnb bust, because there are a lot of investors that wanted to get in on the Airbnb bonanza wagon. And the problem with that is you need to do this for a living. I think we've talked about this before, that Airbnbs if you're going to compete with hotels, you better offer really good service, a really good experience, and something that's different than home. And some people just don't get it. So they have kept the house the way it looks. They bought something. It looks like 1970s, hasn't been redone or anything like that. And they rent it out, and they wonder why they have such a horrible vacancy rate. And because they have one that they do. And maybe they have two and they think they're in it to win it, but they just don't have a really solid game plan. Now, you can see the flip side of it. And if you stayed in enough Airbnbs and VRBOs like I have and our family has, you can actually see the difference. And that's the ones that we choose to stay at, are the ones that are meticulous about making the experience really cool. And those people have multiple properties, and this is what they do for a living. They run their own little like mini hotel chain, but there's Airbnb VRBOs all over the place, and they're very responsive. Their places are cute, unique. They even give them funny names, and they remodel the houses so they look different than home, and it makes it an experience. Those are the ones that will do really well. It's kind of like when you go to a hotel room, you're looking for all the bells and whistles. You're not looking for the Motel 6 if you're looking for an experience, right? So, I mean, if you wanted to stay in something that's just simple and bland, well, then shoot, we'll go hit that local Holiday Inn or Motel 6. They'll keep the lights on for you. But here, what we're asking, what the consumers are asking for is something more. And so there's too many of those onesies, twosies that just don't know what the heck they're doing. And it's a lot of work, and you have to have a lot of them in order to really be profitable. And that's what it amounts to. And unfortunately, there's too many people that weren't in it for that. They were in it for a quick buck. And I think I could do this too, like anybody else, but it just ends up not being as easy as what everybody makes it out to be. It's truly a really solid profession, but you got to treat it like one.
So on a different topic, Meredith Whitney, someone who predicted the great financial crisis, reported that Freddie may enter the secondary mortgage market to allow more people to take equity loans out of their homes. Whitney believes that doing this could stimulate $3 trillion back into the economy. Can you explain to some of our listeners what the secondary mortgage market is and whether doing this really could stir better economic activity?
Yeah. So when you get a loan, typically the bank isn't going to say, here's the money, and then they keep the loan on their books. What they do is they take that loan up, they package it up, and then they sell it off to the secondary market, and then they get money back so they can go do that again, that type of thing. So this secondary market is Freddie Mac, Fannie Mae, Ginnie Mae. There's a few of them, and they do this secondary market thing. It's all in the background. It's nothing that you would know about, but they have very good statisticals. They've got great economists that work there, and they've got great stats, and it's fun to follow all their stuff. That's on a side note. But what they're asking for, what Meredith Whitney is talking about is, Equity line of credit is you've got your mortgage. Now all of a sudden you want to take out a little bit more of your equity. That's the equity line of credit. You already have your house, you live in it, and you want an equity line of credit to pull out to do whatever you want. I'm not for that, and because the economy is already way too stimulated. The United States government has been turning up the notch with each of the last 4 administrations, and this one is no exception, notch turned up even higher, where we're spending way too much money already. We don't need to put more capital into the market by incentivizing homeowners to take money out to push it into the economy. That's not a recipe for success. We're already, just because there are people across the United States that are getting in pickles, like they're putting too much on credit cards, they're getting into automobile kind of debt, and they have these different problems. They're not saving as much. The good old economic system will work itself out. Some of these homeowners that get into a pickle will have to sell, offering a real natural churn. We don't have to come in and save the day for everything that we have, and that's not what Freddie Mac and Fannie Mae and the secondary market was for. It's not for these equity line of credits like what she is proposing or the reporting on. I hope that we're not looking for further stimulus along those lines, because that is it. We just don't need the stimulus of more dollars put into consumers' pockets by them pulling money out and now having less equity in their homes. That's not what we should be encouraging at this point. We learned a lot of lessons from the Great Recession, that being one of them, where you don't use your home as a piggy bank. And people were getting yachts or boats or going on these extravagant trips and just buying a whole bunch of nonsensical things. And it was fueling a lifestyle that just didn't make sense. I don't want to incentivize that. So personally, I think it's not a great idea. I don't line up with Meredith Whitney.
So the previous low rates are to blame why this housing market is currently hurting. If rates were more elevated, would we see more transactions in that case?
Yeah, if we didn't have the low rate environment, I mean, what was hard to even understand is from 1981, when rates hit 18%, if you look over time, rates just continued to fall over time. Lower and lower. Every few years it was lower, every few years lower, until we got to 2018, where interest rates floated back up to 5%. People were freaking out, and then they came back down again, and the Federal Reserve fixed a lot of that. It was kind of like price fixing on their side. They were doing more quantitative easing type of thing. Went into the pandemic, and then we got rates that went down, bottomed out into the 2.65% being the lowest rate in January of 2021, all-time record low rate. Well, from there, it's been nothing but go higher. We haven't had that. We haven't had it where 1 year it's high, 2 years is higher than 2 years ago, that type of thing. That's almost unheard of. And that's what we're dealing with right now. So if we didn't have that, and we didn't bottom out like we did during COVID, because they didn't know better at the time. They were doing everything they could, but they kept rates down too low, and they probably were too aggressive on what they needed to do. And we could have had rates that came down to 4%. We wouldn't have had as big of a problem as when rates got under 4 into the 3s, down into the 2s. It created a bit of a problem and a financial windfall for all people that purchased a home or refinanced their home. So now they're sitting with these very, very low rates. And so you can imagine with doing that, we've already said it precludes a lot of people from placing their homes in the market. But if it was all similar rates to where we are today, let's say interest rates were about 7% today, and they were about 7% 2 years ago, or 3 years ago, and 4 years ago, yes, there would be a lot more movement. It's that because their mortgage rate, they could trade it in for another one, and it won't be a big sting. That's not where we're at, though. Instead, it's more of a sting, so it's limiting the number of homes that we can actually sell right now.
Well, thank you everyone again for tuning into another episode of Let's Talk Housing. Now, if you want to learn about what is going on in the real estate industry across Southern California, the Bay Area, and now Phoenix and Las Vegas, how exciting. Please feel free to check out our YouTube or subscribe today at reportsonhousing.com. As usual, please leave us a good review. And if you have any questions at all, you can leave it anywhere on our social media, or you can email me at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.